Hello and welcome to Livewire Markets. I'm Ali Selby and today we're very lucky to be joined by Katana Asset Management's Romano Sala Tenna. Today we'll be discussing what you can expect for the remainder of the year, why Romano's holding so much cash, as well as some of his favourite stocks. Thank you so much for joining us today, Romano. Really excited for this chat.
Yeah, thanks, Ellie.
What can investors expect for the remainder of the year? Is there a Santa rally on the horizon?
I think so. I think the path of least resistance is for the market to go up from here. You start to see inflows back into US equity funds from this stage. You know, we've literally thrown the kitchen sink at our market over the past little while and it's held up reasonably well, which says to me that sentiment remains robust.
In your latest market update, you talked to the market looking to be a little bit oversold right now. Why is that?
Well, the indicators we use to determine that is really just a momentum oscillator being relative strength index. You can also use stochastic, of course, and any measure below 30 pretty much indicates the market's oversold. Even in a bear market, you're going to see a rally from that level, and that's what we've seen over the last week or so, and we think it's got a bit more to run yet.
Okay, you're mandated to hold around 5 to 35% cash. In June, you told us you were actually holding 40% cash in the portfolio. Why did you breach your mandate?
So we didn't actually breach. Our mandate actually permits us to hold to 80% cash. We try and hold 5 to 35 through the cycle. We got to 40% cash was really a combination of two factors. One was top down, being we were forming a particular view of the market, and also bottom up. We had a number of stock positions that had rallied quite strongly, we'd taken profits from, and we weren't quite ready to redeploy that capital.
That cash weighting has now dropped to 30% in the portfolio. Where have you put that cash to work?
Look, we haven't really picked up any new positions as yet. We've really redeployed that capital into materials and healthcare, which are two sectors that we're currently already overweight in. Why we chose those two sectors? Look, it's more of a factor of where we don't want to be. You know, they're the least worst sectors right at the moment. We don't want to be in financial services. We don't want to be in REITs. We don't want to be in consumer discretionary. So it really means that any additional capital we deploy needs to focus on those two sectors.
I feel like a lot of investors have been turning towards consumer discretionaries. I mean, there's been a bounce in that sector over the last few months. Why are you avoiding it?
Look, we're getting excited. There's some fantastic opportunities that have emerged. Some of the valuations have sort of moved back a little bit now, and we see things like JB Hi-Fi, for example, as being a top 10 holding at some stage, probably the next 12 to 18 months, Nick Scully and the like there. So some great companies that have been sold down. We just don't think that we've seen the numbers yet come through from the 12 rate rises. We think that, you know, it is a lag effect. We did have the COVID buffers. There's still some time to play it. And I think over the next 6 to 12 months, we'll see that sector probably take another leg down. You
talked to being overweight healthcare and materials right now. Why is that?
Yeah, as I said, they're the least worst sectors that we're, you know, in terms of knocking out of the sectors we don't want to be invested in. But also I think from a bottom-up perspective, you're starting to see some really good valuations emerge. For example, in healthcare, you know, it's the worst performing sector last year and the second worst performing sector this year behind information technology. So some companies actually starting to hit valuation levels that we haven't seen almost for a cycle. Things like CSL's on 20 times earnings, you know, ResMed, Ramsay, even Sonic, you know, good companies that are trading at levels you don't normally expect to see. So you really have to capitalise in the healthcare sector when you see the valuations pull back to this point.
And how about for materials and resources?
Yeah, again, we're seeing some really strong cash flow numbers in our models continue to emerge. Yes, we're seeing, you know, some things come off, commodity pricing come off, copper's come off, lithium's come off, etc. Even coking and thermal coal. But even so, we still see really robust numbers compared to pretty much any other sector we're looking at.
Do you want to take us through some of the stocks you're liking within the materials and resources sectors right now?
Yeah, materials, we predominantly like EV-facing commodities. Very hard to play in the Australian landscape. At one stage we had 4 lithium stocks in our top 10. We've now trimmed that back a bit, of course. The lithium price, you know, is really under pressure at the moment. Where it sticks, we're not quite sure. But what we do know is at some stage in the next 2 to 3 years, lithium will have another run. We're quite certain of that. And so we're trying to find companies that are in a bottom quartile through the cost cycle. And they're the ones that will not only survive any sort of cost pressures, but will also thrive once the recovery eventuates. So things that we really still like: mineral resources, IGO, all chem. In the copper space, it's much harder to play. There's only one investment grade copper company in our view left in Australia on the ASX, and that's Sandfire, so we've got a position in that still. And then we've added the copper wire ETF, WIRE.AXW, as being a way to get global exposure to 30 copper stocks.
Can you take us through your highest conviction stock pick over the next 12 months?
Well, I think this time in December last year we chose Mineral Resources as being our best pick, and that hasn't worked out too well to date. But we still believe that all the drivers are in place for that company to perform very well over the next 12 to 18 months. On our models, they've got 3 key divisions, and we see each of those divisions doubling EBITDA or getting close to doubling EBITDA over the next 12 to 18 months. And that's through projects they're currently working on, not things that are yet to be signed off on or potential projects. That's what they're working on. And a simple example is in the iron ore space. Their Onslow project will produce approximately 40 million tonne per annum at about $45 US a tonne. That's currently about 3 times their iron ore production at a much lower cost.
Romano, where are you seeing the most risk in markets today? I feel like we're in a very fractured world right now. There's a lot of geopolitical tensions. What is the market missing?
The biggest risk for us is that the market rallies because we're overweight cash. I think the biggest risks for the market, I don't put geopolitical risks in that basket. I think, it could escalate from here, but at the moment we still categorise it as noise. It is, horrendously tragic what we're seeing unfold there, but from a financial perspective, probability says it doesn't escalate from here. Now, there's a possibility it can, but we're paid to play probabilities, not possibilities. So I think the biggest 2 issues right here, right now in the marketplace, number one is wage inflation. Wage inflation is the most horrendous and difficult form of inflation to counter. If it does get a grip and we start to see that spiral, central banks will need to raise interest rates further to get under control. That's not our base case, but it's certainly a big risk. And I think the second big risk really revolves around something that no one's talking about, which is deleveraging. We've gone through about a decade and a half of leveraging the financial system, and there's now about 5 key drivers, particularly in the US, which are starting to spiral or starting to perpetuate a deleveraging. Now, leverage is the lifeblood of the economy. As we start to pull money out of the system, there's less money for developing new projects all the way through. And so we start to see that the whole economy starts to attract, the global economy starts to contract. So that I think is the biggest issue. Now, in markets, things are never a problem until they're a problem. So it could be a problem this year or next year and in the coming years, but certainly the deleveraging that's underway is going to have a fundamental impact on economic activity.
What would that impact look like?
When it's more difficult to get money, when the global lifeline starts to disappear, then corporate's going to find it harder to raise funds for new projects. You're going to find it corporate profits will shrink, wages will eventually contract, consumer spending will contract. The whole cycle works in reverse. So just what we've seen, spiralling upwards over the last decade and a half, that starts to work in reverse.
Is it a bad time to be investing in equities then?
We never think of it in terms of all in or all out. It's always a continuum in our thinking. So, we try and say, well, where on the continuum should we be? We see 3 main asset classes and a 4th sort of alternative that is a catch-all basket. Property, fixed interest and equities. And we think you need an allocation to all 3 all the way through the cycle. It's a question of how you weight those allocations. Do we think it's a difficult time? Look, fundamentally, I think you can make a very strong case for a bear market evolving from here, but there's also enough strong data points for a bull market. So our base case at the moment is that we're in a range-bound market and that will sort of muddle through over the next little while. Closer to 7,000 odd on the All Ords will put more capital to work. 7, 8, 8,000, that's time to take a bit of capital off the table and wait for the next pullback. So, we've been in a range-bound market for the last little while. Our default position is that continues until either the bull or the bear case, breaks out.
Okay. It's obviously very volatile right now, as you alluded to just there. How do you control your biases or in that environment?
I think that's the most critical thing. Like, I think the most successful fund managers aren't the ones with the highest IQ, they're the ones with the highest EQ. And, you know, how do you look at your blind spots and your biases and, you know, things you don't know? I think the first thing is you have to identify them. The second thing is you then have to change what you can change. And the third thing is you have to put in place mechanisms to handle what you can't change. You know, we're all wired in a particular way, and some of the wiring runs quite deep. You need to understand how you'll respond in certain situations. When the prices go down, you know, what's your natural emotional response? Is it to hope that it goes back up, or is it to fear you're going to lose more? In that situation, you know, one of the four great emotions, fear, greed, ignorance and hope, in that situation we should fear losing more and actually take a stop, be disciplined. A poor investor, conversely, will actually hope they'll regain their capital and hold on. Greed is not a bad thing. Greed is a bad thing when your emotion of greed takes place at the wrong point of the cycle. If a stock's going up, you should hope that you'll get more or have greed that the stock will go higher. A poor investor will actually fear they'll lose their profit and sell too early. You know, a more emotionally balanced investor will understand that the stock's in an uptrend, that there's some drivers there, and they need to give it a chance for that to play out. And sometimes these things play out over many months and years.
How have you learnt to control those biases yourself, though, over time?
Yeah, look, you know, I think fundamentally, for example, I'm wired poorly as an investment manager. You know, I came to recognition some time ago that, you know, when a stock falls, I have the wrong emotional response. So the way that we've overcome that is firstly to identify that, secondly to change what I can change in terms of understanding and so forth, then thirdly to put in place mechanisms that enable us to handle what I can't change. And at Katana there's two things that we use to do that. One is a very clearly defined and mandated process and criteria that we step through. And the second thing is groupthink. You know, there's four very robust investment professionals in our team. We critically examine each other, we critically challenge each other, and it helps us to identify our blind spots and to overcome them.
Okay, thank you so much for your time today, Romano. I really enjoyed that chat.
Thanks, Sally.
If you enjoyed that too, don't forget to subscribe to Livewire's YouTube channel. We're adding so much great content just like this every single week.